Automotive Components Limited Q4 and FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Anuj Talwar, Managing Director. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. A very warm welcome to the Talbros Automotive Components Limited earnings call for quarter four and FY26. On the call today, I am joined by Mr. Naveen Juneja, our Director on the board, our Group CFO, along with the IR advisors, SGA. The results in the investor presentation have been loaded on the stock exchange and the company website. Before I take you through our performance, I would like to spend a moment on the broader industry landscape. The Indian automotive industry closed FY26 on a strong note. Despite a challenging global environment marked by geopolitical tensions, supply chain disruptions, inflationary pressures, the domestic automotive ecosystem demonstrated resilience. This also helped a lot with the GST cut, as well as increased government capex and rural recovery. In quarter four FY26, the passenger vehicle segment continued its momentum, posting its highest ever quarter four sales of 13.16 lakh units, representing a 13% YOY growth. Demand for SUVs and premium vehicles remained robust, while even the entry-level segment saw gradual recovery driven by affordability, improvements, and supportive financing. The two-wheeler industry registered its highest quarter four sales of 57.73 lakh units, a growth of 26% YOY. The implementation of GST 2.0 provided a meaningful boost in Q3 and Q4, complemented by rural recovery and improving consumer sentiment. The segment's resurgence is particularly significant for Talbros, given our market-leading position in gaskets for two-wheelers, where we are pretty much single source in one of the second or the third largest OEMs in the country. The commercial vehicle segment delivered its highest ever quarter for volumes, recording 3.25 lakh units sold. Simultaneously, electric mobility continued to gain traction. EV cars grew at about 50% YOY in quarter four, while EV two-wheelers grew at 39% YOY, again, expanding to a better charging station network and also, urbanization of the rural cities as well. On the global front, structural challenges in Europe's automotive industry, weak OEM and Tier 1 balance sheets, supply consolidation, a global OEMs actively reducing China dependence, are accelerating supply chain realignments towards India. This you have seen not now for many, many quarters that our exports get healthier and better. We are benefiting from this kind of a change in the supply chain decision-making at the procurement level in Europe and UK. Coming to company performance, I'm extremely pleased and delighted to share that Talbros Automotive has delivered its strongest ever quarterly performance in Q4 FY26. Our consolidated revenue from the operations stood at 237 crores in the quarter, with a growth of 15% year-on-year. At the EBITDA level, at Q4, we declared EBITDA of 45 crores, a growth of 12.9%, and a record high margin of 18.7%, reflecting robust operating leverage and disciplined cost management. PAT for quarter four grew 19% year-on-year to 32 crores at a PAT margin of 13.1%. It's IPL season. We crossed the century in PAT, and for the first time, we ended the PAT at 104 crores for the year ending. Coming to our divisions, our gasket and heat shield division remains the largest and the most profitable contributor to our business, accounting for 52% of the revenues. In quarter four FY26, the division delivered a revenue of 164 crores, a growth of 15% year-on-year, with EBITDA growing 18% year-on-year. The Q4 revenue mix is largely supported by two-wheelers and passenger vehicles. The division benefited from strong OEM demand, higher penetration in premium vehicle platforms, and continued traction in our heat shield business line, which remains a high margin and a high growth business. We hold a 50% market share in the Indian gasket market, 3x near the nearest competitor, and are market leaders across two-wheelers, agri, off-highway, and commercial vehicle segment. We are a single-source supplier, as I mentioned earlier to you, to 4 of 5 of key customers within the country, which shows a lot about our trust and quality with the customer. The heat shield segment continues to scale meaningfully, with FY20 revenues at 58 crores. Our exclusive partnership with global companies for lightweighting aluminum heat shields is exciting. These products offer value-added features, including noise reduction, emission control, and thermal insulation for new generation engines, including hybrids and EVs, making it a very futuristic product with high margins. Coming to the forging division, in Q4 26, the forging division delivered a strong recovery with revenues of 76.2 crores, up 11% year-on-year, validating the normalization we anticipated after export headwinds in Q2 and Q3. As a one-stop solution provider for hot forgings with press capacities from 752,500 tons, we offer comprehensive capabilities spanning die design, machining, and heat treatment. Exports in this division are still at about 56% of the revenue, with marquee customers like JCB in the UK, Dana in Europe, Carraro Europe, GK in Europe, Musashi, and Jaguar Land Rover in the UK. New orders worth 500 crores have been secured in the forging business, with a significant portion from new onboarded major European car maker in Europe as well. With European OEMs actively looking at consolidating their supplier base in India and a preferred alternative to China, this is a great opportunity for our forging division. Coming to our joint ventures. Our two joint ventures had an outstanding year. Marelli Talbros Chassis Systems, our 50/50 JV with Marelli, reported full-year revenues of 346 crores with a growth of 21% year-on-year, and Q4, it grew at 35%. EBITDA grew 35% for the full year to 62 crores. Over 90% of this division's revenue comes from the passenger vehicle segment, with key customers like Maruti, Tata, Jaguar as well. The JV manufactures control arms, front axles, rear axles, and critical components of the chassis spectrum. EV revenues now account for 5% of this division. We're also waiting for some orders to come in from luxury EV makers in the world. Coming to Talbros Marugo, our 50/50 joint venture with Marugo Rubber Industry Japan, which manufactures anti-vibration products, including mounts, strut mounts, suspension bushes, rubber bushes, muffler hangers, has nearly tripled its revenue over the last 5 years. Approximately 90% of this company's revenues come from Suzuki, Maruti Suzuki. New domestic orders worth 170 crores have been secured for hoses and anti-vibration products, showing good growth in the coming new years. The Lohan Talbros joint venture, announced in H1 of FY26, marks our entry into ESG, advantage circular economy space, focused on recovered carbon black and de-vulcanized rubber. With the RC market growing at 35% CAGR and the de-vulcanized rubber growing at 10% globally, this is a technology-led differentiated growth avenue for Talbros. The JV is expected to commence operations from July to October 26. Exports remain a key pillar of our growth, contributing nearly 1/4 of our revenue this year. We continue to see strong opportunities from global supply chain shifts, increasing outsourcing by OEMs worldwide, and India's growing position as a manufacturing hub. Recent trade developments with Europe and the UK should further strengthen this opportunity. While the West Asia war may lead to some temporary cost pressures, inquiries remain strong, and we believe Talbros is well placed to navigate these challenges. Coming to our capex, FY26 has a strong year in terms of new order wins. Over the last several quarters, we've secured significant new businesses from both domestic and global OEMs, as well as EV platforms. In line with this growth visibility, we are undertaking a capex of approximately, we are going to invest 51 crores in 26 and plan to invest about 103 crores in 27. FY27 and beyond. As we mentioned earlier, the company is now moving from a phase of order acquisition to execution. Our focus is on timely delivery, ramping up capacities, maintaining good global quality standards, and we convert this strong order book into sustained revenue and profitability growth over the coming years. Our focus will be depending on deepening relationships with existing customers in India as well as overseas. We remain confident of delivering a 15 to 20% year-on-year growth in 27. The demand is still looking good in quarter one as I speak, and we are going to add capacities accordingly. Our focus will be to maintain EBITDA margins between 17 to 18% through product mix and operational leverage as well as cost management. As you all know, there are inflationary pressures that are coming our way, but we have to manage that, and we'll try and pass on the cost to the customers. To further strengthen the company's org structure, we appointed Ashish Gupta as the CEO of Talbros Automotive Components Limited. He previously served as the CEO of Marelli Talbros and brings over 35 years of experience across diverse industry. His career includes senior roles in India and international markets, including Germany and the CIS region, with strong record in setting up and scaling up new plants and manufacturing operations. As I mentioned, his appointment marks an important step towards further strengthening and professionalizing the leadership team at Talbros Automotive Components Limited. Our philosophy of being one of the most hedged auto farm players, supplying across all vehicle segments, all powertrain types, including EV, across domestic and global markets, puts us in a good position. With that, I'd like to hand over the call to Mr. Dineja, who will take you through the financials.
Thank you, Anuj. Good afternoon and a warm welcome to all the participants. As mentioned by Anuj, we are pleased to report a solid performance in Q4 of FY26, driven by both domestic and export demand across all our business segments. Consolidated financial performance for Q4 FY26. For Q4 FY26, revenue stood at 241 crores as against 211 crores in Q4 FY25. For Q4 FY26, EBITDA stood at 45 crores with a margin of 18.7%. Total revenue from operation for FY26 stood at 889 crores as against 845 crores in FY25, registering a growth of 5% on YOY basis. EBITDA for FY26 stood at 155 crores as against 147 crores in FY25. EBITDA margin remained healthy at 17.5%, reflecting the benefits of operational improvement, cost management initiatives, and a better product mix. Profit after tax for FY26 stood at 104 crores as against 94 crores in FY25, registering a healthy growth of 10% on YOY basis. Now coming to a division-wise performance. Now I come to gasket division. First, the gasket division in Q4 FY26, sales for this division stood at 164 crores as against 143 crores in Q4 of FY25, with a year-on-year increase of 15%. EBITDA for Q4 FY26 stood at 31 crore, which is up by 18% on YOY basis. In FY26, gasket sales saw a growth of 7% and stood at 595 crores as against 556 crores of FY25. For FY26, this segment saw EBITDA of 105 crores, which were up by 9% on YOY basis. The gasket and AC division continued to perform strongly during the year, driven by robust OEM demand, increased content per vehicle, and higher contribution from premium and export platforms. Now coming to the forging division, in revenue in Q4 of FY26 stood at 76 crores as against 68 crores in Q4 of FY26, showing a growth of 11%. EBITDA stood at 14 crores in Q4 FY26 as against 13 crores in Q4 of FY25. In FY26, the total revenue stood at 295 crores as against 290 crores in FY25. EBITDA for FY26 stood at 51 crores as compared to 52 crores for FY25, flattish EBITDA. The company expects to continue the growth momentum in the coming quarters. Now coming to the Marelli Talbros Chassis Systems. Revenue for Q4 FY26 stood at rupees 104 crore as against 76 crores, a growth of 35%. EBITDA for Q4 FY26 stood at 18 crores, a growth of 32% on YOY basis. For FY26, the revenue stood at 346 crores versus 285 crores, registering a growth of 21% on YOY basis. For FY26, EBITDA stood at 62 crores as against 46 crores, a growth of 35% on YOY basis. Marelli Talbros Chassis System continued its growth trajectory, supported by increased penetration with OEMs and strong demand for chassis applications. Now coming to our last JV of Talbros Automotive Private Limited. Revenue for this division in Q4 of FY26 stood at 42 crores as against 34 crores, a growth of 24% on YOY basis. EBITDA for this division stood at 6 crores in Q4 FY26, which was up by 28% on YOY basis. Revenue stood at 147 crores in FY26, as against 130 crores, a growth of 13%. For FY26, EBITDA stood at 19 crores, up by 14% on YOY basis. Talbros Automotive also delivered healthy growth during the year with improved operation efficiency and stronger customer engagement. Geopolitical tensions in the West Asia region led to an increase in raw material and freight costs. The ongoing situation may also result in temporary shipment delays and supply chain disruptions across certain export markets. The company continues to maintain a healthy balance sheet while investing in future growth opportunities through capacity expansion, technological enhancement, and product diversification. With a strong order pipeline, healthy demand outlook, and continued focus on execution excellence, the company remains confident of sustaining growth momentum going forward. Thank you. This is all from my side. Now I open the floor for question and answer. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Anubhav Mukherjee from Persian Capital. Please go ahead.
Am I audible?
Little loud. Yeah, you are audible.
Is this better?
No,
Hello.
Still cracking. It's very coming very high pitch.
Sir, is this better now? Hello.
It's better now.
Sir, thanks for the opportunity. Sir, my first question is that if I look at the order wins declared in our investor presentations over last 3 financial years, it seems that we've declared order wins of almost close to 4,000 crores. But the revenue growth over last since FY24 has not been in line with that kind of order win. And I understand that some of the issues have been with international OEMs and European OEMs, but Apart from these external issues, were there some other factors like internal factors because of which like the order win has not like converted into the kind of revenue growth?
Yeah, I can tell you for that. First of all, of course, we declared the revenue. If we come to the exact order book, in 23-24, we declared an annual order book of 326 crores. Okay, total 5-year peak volume order book of 326 crores for a period of 5 years. Out of which we have delivered in last year 27 crores. So if you multiply by 5, it will be that. In 26, we have generated revenue of 51 crore from that order per annum. Again, we declare a 5-year, in 24-25, we declare 431 crore order book for a period of 5 years. Out of which in 25-26, we, I think, built around 37 crores out of that. And the order book which we announced last 1.5 years, major orders of in chassis division of 1,000 crores, EV orders of European customers, that got delayed. Now, some majority of which is coming into production in the current financial year. Our 1,000 crore order for chassis for Stellantis is coming burning in the month of June. This year we are expecting, that was for 5 years, 150 crore order per annum. Out of it, we will deliver around 100 crores in this financial year. Second order was for our European car manufacturer for EV vehicle, which got delayed. Initially, they said they will make 100% vehicle EV, but now they are doing 50-50. So that order of supply will start from the month of September. The US vehicle has been established. Third order is for our business, for our heat shield business, majority of 100 crore order for our Korean car manufacturers. That order has started, which is around 20 crore per annum. And the fourth order, which we announced last year, for our forging division of 500 crore, that order commercialization will start from October. This is the broad thing I can tell you. So things are happening. Okay, it's not delayed 1 year here and there. Last year we were expecting this order to commercialize. They didn't commercialize because it's an ABCD. Now I think that pain is over and now we are back on track.
Great. Sir, just a small follow-up to understand this better. What will be the current total order book outstanding across different businesses? That will be helpful.
The order which is yet to be, the orders which we could declare on the basis of the volume projected by the OE customer, first of all. Whether if they say 2 lakh vehicle per annum, 1 lakh vehicle per annum, we assume that number. But going to peak, it will take 2-3 years. First year they will take 50%, then 60%. Sometimes they will not pick after 70-80%. They will, for costing purpose, they will show us the value. And it's very difficult to. I can say that by the end of this year, 70% order will be commercialized. Our total order book.
Yes,
Continuous order commercialized, the new order comes, then it goes like that. It's a continuous process, very difficult to track because some are very small orders, very difficult to track each and every. We track only big orders.
Yes, and sir, that now Mr. Ashish Gupta is transitioned into CEO for the overall company. Can you give us a sense of what will be his key KPIs and focus areas for the company? That will be helpful. Yeah.
He has just joined a month back. Give him some time. We will come out with this KPI, etc. Not on the call. I think we will meet and tell you the KPI target. We will try to show you what our outlook he is having for the company for next 5 years before Diwali, I think so. We will need to wait till then. He's working on that.
Yes. Thanks, sir. That will be helpful. And just final question before I get back in the queue. Sir, I was looking at the CAPEX plan for the NTCS JV. And it seems that the CAPEX plan amount has been reduced compared to what we declared like end of last financial year. So am I reading that correctly or like?
You are right. You are right. We were first planning to have our Gujarat facility in the current financial year. Now with the order we have received from Maruti and Tata Motors, so accordingly they require SOP will start on later date. So the capex of Gujarat will now be shifted to 27-28. That is the only reason.
Okay.
But it will be on. We'll start looking for the place in the third quarter, and next year it will be commercialized. It will be online.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Kaushal Shah from Danki Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity. So just in continuance to the last question, you also mentioned that we have won orders in the standalone business, the gaskets and sealing and forgings. And you also spoke about the commercialization. So this year, compared to last year, should we see a double-digit kind of a top-line growth in our standalone businesses?
Yes, sir. Definitely we will get a double-digit growth. Yes, sir. Because some orders which are commercialized, at least 60-70 crores new billing will happen from new part numbers. Minimum.
So that includes both the gasket and sealing as well as forgings, or it is just one?
The forging commercialization will start from October. So this year, only 20% will come. Next year, full will come. That's why we are increasing capex of 50 crore for that business.
Correct. Okay. And on the margins front, sir, for the last financial year, we were been able to hold our margins. But how do you see the current year, given that there are input cost pressures also? So how do you see the direction there?
So we will be able to maintain the margin. I just want to my request investors, don't look quarterly margins. Wait for the year, because when we launch the prices increase we have launched with the customers. Sometimes it takes 1 month, sometimes it takes 3 months to settle. So we will recover everything. Majority of price increases we will recover. Because we have a proprietary product and we have arrangement with all the OE customers, whether on the exchange front or on the metal front, the raw material front. We get the price increase or decrease, whatever it is. But the request is not to look top line, don't look the margins moving here and there, doesn't make a difference. At the end, we will be there.
Right. And sir, if you can throw some more color on the capex front, how much are we spending this year, and if you can split it into the standalone business as well as the associate companies, and for the next year?
So next year I will not comment now. I will comment only for this year, because this is confirmed. Next year we will work it out at the end of third quarter. So this year we are expecting to invest 16 crore capex for in gasket and heat sheet, primarily for the new business, plus the new business we are expecting from coming USA, and to take growth of. We will able to maintain that, because the capex is not very, very heavy in this business. Asset turnover ratio is 3+.
Okay.
In the forging, we will put a capex of 60 crores for the new business of Marelli. We discussed on 90 crores, plus other businesses of Dana and GKN. Out of it, 45 to 47 crores fit for the plant and equipment. Balance is for the infrastructure. Okay, we need to have more infrastructure, power line, etc. Is that? I think it will be enough to take us forward for the whole Marelli business of 90 crores we can do from this capex, plus new businesses of 15-20 crores we can do from this capex. Now, coming to Marelli we expected to do a capex of around 20 crores. Because we need to add more machines for our European customers. Balance, Stantis business capex already incurred. we need not to do any other further CapEx. Only the business of European car manufacturers, we will do a CapEx for that. And Gujarat CapEx we will do in 27, 28. And Margo will do a CapEx of around 7 crores, which is required for basically plant and equipment because their machines are not very, very expensive. So that will end up for us. And I think this whole CapEx will be completed by September, October. Before that, I think 35% already we have done out of this.
Thank you, sir. I'll join back in the queue.
Okay.
Thank you. The next question is from the line of Subhash Gade from Choice Equity Broking. Please go ahead.
Yeah. Sir, can you hear me?
Yeah.
Yeah. So, sir, actually, more of the questions are already answered. So, one of the question is that, like, what will drive the aspiration growth target of something around 18 to 20%? And is this going to be a purely organic?
Can you repeat the question, please?
Yeah. So, what will be drive the aspirations growth target of 18 to 20% going ahead? And it is going to be a purely organic growth or something inorganic growth are going to include?
So I'm talking about organic growth. How can I arrive? I will talk about consolidated basis. I will not talk business. Because individual. Last year we closed as a consolidated group turnover of 1,383 crores. Okay, 1,383 crores. The new business which is already commercialized and go commercialized in the month of June and October, around 150 to 160 crores. That will come in here. So it will give me a growth of 11-12% by new business. Balance is for the economy to grow by 6-7%. It will come.
Okay. Got it.
Okay. Thank you.
Thank you, sir.
Thank you. The next question is from the line of Smitesh from Redan Capital. Please go ahead.
Hello.
Yeah.
Yeah, hi sir. Thank you for the opportunity. Sir, I just wanted to confirm you have said 16 to 20% revenue growth for FY27. Is that correct?
Yes, it's correct.
Okay, perfect. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Shikha Mehta from Time and Tide Advisors. Please go ahead.
Hello, sir. Am I audible?
Yeah, audible, Shikha.
Congratulations on a great set of numbers. I just have a few questions. One is on the forging division. Have we seen margin compression this quarter in forging division? Because revenue grew at 11% and EBITDA grew at 3%. So I'm trying to understand what happened there. And can you also help us understand what the way forward is specifically in the forging division?
Yeah, as you are aware, in the forging division, all the raw material increase or decrease passed to our customer, and we reset the exchange rate up every quarter. Okay? There was a price in the month of July, August last year. We didn't pass on the price decrease to a customer, saying that the volume is not coming, etc., because now we have to pass that price decrease to the customer from 1st of January. Secondly, with the exchange going haywire, in rupee depreciating a lot, we have to reset the prices as of 1st January. So the initial benefit we are getting for last 2, 3, 4 months was passed on to a customer, not fully, but 60-70% passed on. That's why this quarter little margins is under pressure. But going forward, it's fine. Because we have done for the past quarters also in this quarter.
So, if I try to make some sense of that, if forging margins are to come back to, somewhat semblance of normalcy, then overall we can deliver, if not the same, better margins as well as a group entity. Would that be the right way to look at it?
Yeah, it will come back, ma'am. It will come back in 1 or 2 quarters. You can see that.
Understood. And sir, in our last conference call of Q2, we had mentioned that a few orders would start from Jan and have been deferred. I think Kawasaki, Kia, and Cummins. So can you give me, guidance on that? Have we started that in Jan, or has that further been deferred to Q1 of FY27?
Ma'am, first order of Kia is started from the month of February, small volumes. Okay? Now this year it will be full force from 1st April, no issue. Second order of Cummins, Stantis was that, was supposed to start January, whatever, it got delayed by 1 year. Now it will be, now production has started on that order, and first billing will be done for the month of June. Okay? Now, there are two major orders. Of course, Cummins order was not there. Cummins order. The third order of JLR, of course, it got delayed. Now the billing will start from September. That is the position. Major order I'm talking about.
Okay. Understood. So, again, broadly listening to what you've been saying, maybe H2 for us will be significantly better than H1. Is that the right way to see it?
Of course, it will be better, man. It will be better. Quarter month will be, top line should be in line with last quarter, should be.
Okay. And so lastly on Kawasaki, I'm sorry, I think your voice dropped a bit. Did you mention something?
I couldn't get you, ma'am. I couldn't get you.
On a
So
Kawasaki,
Cummins orders are yet to come. So the orders already announced that they're already here. Cummins has some are trickling in as well.
Yeah.
All right. Okay, thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and one to ask a question. The next question is from the line of Atul Jobi from Prosperity Wealth Management. Please go ahead.
Yeah. Hello, sir. Am I audible?
Yeah.
Sir, on the last earnings call, you mentioned that we will be able to achieve 11,000 crore top line on FY27. So, are we sticking to that number?
But what we said, we will top line of
1,100 crore.
I couldn't get you.
Yeah, a top line of 1,100 crore.
Yeah, this year we should be able to cross 1,000 crores.
Okay. So also, on the margin side, will you be able to?
We are targeting for crossing 1,000 crores this year, definitely.
Okay. So also on the margin side, will you be able to maintain the current EBITDA margin range going forward in FY27 also?
Around 17% definitely.
Okay. Yeah, that's all from my side. Thank you, sir.
Thank you. The next question is from the line of Dipen Shah from Six Senses. Please go ahead.
Thank you for the opportunity. Am I audible?
Yeah, audible.
Congrats on a good set of numbers, sir. Just had one question. Over the past couple of years, we have been seeing that the company has got a good number of orders in domestic as well as in the export market. So could you just give us some more color on, when you get orders in the export market from established OEMs, what is your right to win? And, in the sense that what's the USP which you have because of which you're, either able to substitute existing vendors or maybe get new orders for new products. So maybe some more color on some qualitative aspects on why are you winning those new orders and, what do you expect going ahead?
Number one. Sir, number one, every OEM has a cost pressure overseas. Mm-hmm. The costs are in and their companies are under that, or whatever you are saying, the cost is very, very heavy. Mm-hmm. So they were looking for making India because all bigger OEMs have a IPO here, International Purchasing Office here. Mm-hmm. So we have the experience of handling all these big OEM customers. So whenever through IPO, sometimes through shows and sometimes through personal meetings, they give us the opportunity. My cost is, there are two things, but I am providing in the same or better quality as compared to India, existing vendors. Some of the existing vendors, in some cases, business came to us, they went bankrupt. The vendors went bankrupt. And as a result, they were demanding advance money for buying raw material, then we will supply. Okay. Yeah, this is practically happened with one or two vendors of big OEMs. Yeah, they got the money. They said give us money. After that, which problem I proved this COVID के बाद this problem escalated in a major way.
Mm-hmm.
So they got up and they were dividing. Now they want to get rid of it. They came to us and gave a solution. We are supplying to them at a 15-20% cheaper, at a cheaper price.
Okay.
The same thing. Of course, they have to defend us. We are a single source. They have to maintain inventory. We have to maintain inventory. That pain is there. But the only thing they realize that the cost saving is coming. Drastically cost saving is coming because they need to compete with China, etc. They want like vehicles, Chinese vehicles, they need to compete. They want to bring their cost down. So that is a major, I think, advantage we have over that. And plus, customer relationship also there. So that everything, because our financial strength, everything.
Okay.
I'll also like to add to what Naveen said.
Yeah.
I think customer engagement at every level, whether it is my level, whether it is CEO's level, whether it is the business development person's level, and quality costs is definitely the main mantra for this, and also China plus one. But customer engagement at all levels. I mean, we have rosters for all our business development people to travel to the Europe of the world, the UK of the world, America of the world. Keep engaging, constantly engage. Whenever you go to meet an OEM, if he's happy with you, he don't give you one part number, he give you 10 part numbers. So that matters a lot as well at every level.
Okay. And the recent FTAs with UK and EU, will that help us in any manner?
Not affecting components really, no.
Not affecting. Okay, thanks. And the last question is, did I hear you correctly, Mr. Juneja, that the first quarter numbers should be similar to the fourth quarter? Did you mention that? Top line
I'm talking about.
Top line. Okay, sir. Thank you very much and all the very best, sir. Thank you.
As of today, I can say that it should be around that.
Okay. Thank you. Thank you so much.
Thank you. The next question is from the line of Neil from Equity Capital. Please go ahead.
Hello. Am I audible, sir?
Yeah.
So we've been saying that the JVs have been performing really well. And I guess in the past 1 year, they have been doing the heavy lifting for the Talbros. So going ahead, do you have any guidance for both the JVs?
Yeah, next year I am expecting Marelli JV should be around 35 to grow between 35 to 40%, and Marugo should be around 15%. This is the top line guidance.
I beg your pardon, 15% for Marugo.
Yeah, 15%, around 15% for Marugo, and Marelli should be between 35 to 40%.
Okay. So I have another question. In your presentation, you mentioned that amongst the top 10 customers, Maruti contributes around 20%.
Yeah.
And second is Tata Motors, that is around 9%.
Yeah.
So my apprehension is that don't you think this could lead to a customer concentration risk for the business? The Maruti is contributing the maximum.
Maruti
yeah. I'll answer after you. Hello? Yeah, I was just saying, I just want to make a point. A lot of if you look at peer comparison, most peer comparisons, 90% peers of ours are dependent 60 to 65% on a customer. Now, the reason you see Maruti 20 is because the Indian passenger vehicle industry has really taken a boom in the last 6 to 8 months, and the car content per vehicle from our joint ventures is much higher, and the H is also going up. So it's very, very healthy. It's not a problem at all. It's still a very, very hedged portfolio. 20 is very, very healthy. I mean, people at 60, 65%, we should worry about them because we're pulling. And now also don't forget, exports we are talking about will reach 30% in the next 1 or 2 years. So you'll see ratios changing. So I'm not worried about that at all.
Okay.
Maruti, my components from all divisions are going in Maruti. That's the one reason in rupee term share is high. Rupee term. Because per component contribution in Maruti is very high. Maximum in Maruti per vehicle contribution. Because chassis goes there, heat shield goes there, Margo ka to all products goes there. All the divisions putting products goes there, except forging.
Okay, sir. Sure. Thank you.
Thank you. As there are no further questions, I now hand the conference over to Mr. Anuj Talwar for closing comments.
Well, thank you all for joining the conference. We are proud of our achievements of quarter four last year and the year ending. We are confident of quarter one being strong, as Naveen mentioned. We are strong in our order acquisition. At the same time, there are inflationary pressures, not only for us, but across the country, across segments, across industries. But we'll make sure we manage them and deliver a better performance than the past. Thank you so much.
Thank you.
Thank you. On behalf of Talbros Automotive Components Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.